This conference will now be recorded.
All right, let's talk about medical expense plans. We're going to cover basic medical, supplemental medical expense plans. Sometimes you'll see the supplemental major medical expense plans and the comprehensive major medical expense plan. So starting with the basic program, first thing you need to understand, it's a first dollar coverage plan. Whenever you see first dollar coverage plan, it means there's no deductibles. That means with this particular program, if you get a splinter in your finger or a paper cut, you can go in and they'll take care of it without any deductibles. So knowing there's a program out there with no deductible, it's kind of pricey. And when you see the word basic, basic means limited. So the hospital, there's three parts, or I should say, hospital, medical, and surgical. Now you can buy them separately or you can package it up in this basic medical expense plan. So a hospital covers room and board. That's the bed, semi-private room in a hospital. This has a limitation of, let's say, $500 a day. Well, if your daily room and board is $3,500 a day, this is going to pay $500 a day for maybe 30 days. So there's a dollar limit and there's a time limit on this program. The medical portion, we usually pay a multiplier of the room and board rate. So if the room and board rate is $500 a day, we'll use a multiplier maybe 10 or 20 times that. Let's say 20 times. So 20 times $500 is $10,000. That's what you get to cover your medical care. Lab tests, x-rays, MRIs, CAT scans, that's all you get is $10,000. Right? So like I said, this is a limited program. And the medical care, that covers everything except for the bed, and it doesn't cover surgery either. So the surgical expense portion, right, it's based on what's called a relative value. You might see relative value unit or a relative value table. Right? So basically, think of every surgical procedure you could possibly imagine, and we'll put it on a list. And that procedure will have a relative value, which is a number right next to it. Right? So let's say, someone needs gallbladder surgery. Well, we go to this list, we look up gallbladder surgery, and it has a relative value of, let's just say, 40, right? And so we take that 40, we multiply it by the conversion factor, let's just say $200. So we take 40 times $200, and that's basically $8,000, and that's how much we'll pay for your gallbladder surgery. Gallbladder surgery, probably around $40,000, okay? And this policy will pay $8,000 towards your $40,000 surgical procedure. The rest is coming out of your pocket. So again, whenever you see basic means limited, it's first dollar coverage plan, so there's no deductible, but it doesn't cover a whole lot. So you might want to go into the major medical expense plan and try this instead. It's more of a catastrophic loss coverage. It's going to give you higher dollar amounts and also give you a coverage for longer time periods. Now, some characteristics of this, now we have deductibles. There's different types of deductibles. The most common one is a calendar year deductible. So let's say you bought a policy, your calendar year runs January through December. You have a $250 deductible. If you go to the doctors in February, you pay the first $250 of any loss, right? Once you pay that $250 deductible in February, well, then you've met your deductible for the rest of that calendar year. That means if you went in a couple times later that year, you wouldn't have to pay the deductible. You've already met it in February, okay? A per cause deductible. This would be every time you go in, you'd have to pay like $100 deductible. I kind of equate this to an expensive copay if you're familiar with HMO. It means every time you go in, you got to pay something before the insurance kicks in, right? So that's a per cause deductible. So now let's go back to the calendar year deductible. Let's say $250. Well, if you have a family, husband and wife, let's say 3 kids, and they each have a program, then they each have a calendar year deductible. So that means if the whole family went in, that's 250 times 5 people if they went in that year. And so some companies have a family deductible. What that means is if you have 5 or 6 family members, if 2 or 3 family members meet their full deductible, we're going to waive the deductible for the rest of the family during that policy period. Right? So again, helping families cut costs is what that's about. Common accident provision, or sometimes called a common accident deductible. So what that is, still dealing with the family. If the whole family is injured in one accident, then one deductible would apply. Right? So again, helping families cut costs. So it's a common action provision, sometimes it's called, or a common actioning deductible. Now, after you pay the deductible, the insurance company doesn't cover the rest. Now we're going to cost share. This is called coinsurance. So the most common coinsurance is 80-20. Could be 70-30, 90-10. And what it is, after the deductible is met, now you're going to share in the cost of the claim. Right? With an 80-20 coinsurance, that means after you pay a deductible, you're going to then pay 20% of the claim. And the insurance company pays 80% of the claim. Right? And that's great if you have some minor stuff. But if you have radical surgery incurring $200,000 of medical bills, right? You pay a $250 deductible, then you're paying 20% of the $200,000. That's $40,000 plus your deductible. I mean, why have health insurance if you're still liquidating some assets to cover the cost? And so hopefully cover the cost. So hopefully you have an out-of-pocket or stop-loss limit. And so let's say it's a $5,000 limit. Right? That means you're going to pay your deductible. You pay 20% of the claim until you paid $5,000. Once you paid $5,000 plus that deductible, then the insurance covers the rest. Right? Now, some stop loss limits have a deductible inclusive or non-deductible inclusive stop loss. So let me explain that. So on the left-hand side, let's say you have a $5,000 deductible inclusive stop loss. So you're going to the doctor, right? You pay your $250 deductible. You pay 20% of the claim up to $5,000. Right? So let's say you have a claim of $80,250. In this case, deductible 20% of the claim up to $5,000. Once you paid $5,000, the insurance company covers the rest. Right? So that means deductible inclusive means the deductible is part of that $5,000 stop loss limit. Now on the right-hand side, if you didn't have a deductible inclusive stop loss, same claim, $80,250. You pay your $250 deductible. You pay 20% of the claim up to the $5,000, but you had to pay $250 plus that stop loss. So it's $5,250, $5,250 what you'd have to pay. Okay. Again, watch the test question whether they give you a deductible inclusive stop loss or they just say stop loss of $5,000. If you don't see deductible inclusive, remember, it's the stop loss plus the deductible is the amount you need to pick for that test question. Again, so why don't we get a basic program, and then we'll add a supplemental major medical program to it. Right? So what you want to do is you want to start here at the bottom. Oops, let me back up. If you go to the doctors, your basic plan pays up to its limits, let's say $10,000. Then you're going to pay a deductible before the major medical portion kicks in. There's that coinsurance and, of course, up to a stop loss. And so the basic covers a little stuff. The major medical covers the big stuff. So between the two programs, it's pretty comprehensive. Okay, but we're buying two policies. And with two policies, it's two policy fees, two admin charges. So then we'll go to something called a comprehensive major medical expense plan. And this is where we're actually taking the basic and the major medical and we're combining it. So kind of like the last scenario, the basic plan pays up to its limits, and then you have this corridor deductible. This is another type of deductible, and this is a common test question. A corridor deductible is a deductible that sits on top of a basic plan that the insured will have to pay before the major medical portion of their policy kicks in. Again, subject to a coinsurance and a stop loss. So instead of buying two policies, a basic and a major medical, let's just get one, the comprehensive major medical expense plan. It covers both of them. The basic portion covers little stuff, and the major medical portion covers the big stuff. Right? Some other items you need to know on the exam, if you ever see commercial insurers, they're basically talking about stock and mutual insurance companies. Right? Service plan or service basis. Let me explain this. You go into the doctors and hospitals and you get the care that you need. The doctors give you the bills. You fill out the claim form, you attach the bills, you send it into your insurance company. If the insurance company pays the doctors and hospitals directly, this is called a service plan or benefits provided on a service basis. Right? It just means we're paying the doctors and hospitals directly. But in some cases, you go and get the care. Your doctors and hospitals send you the bills. You fill out the claim form, you send it to your insurance company, and the insurance company may actually cut you a check. That's to reimburse you for the expenses because you've already paid for it, or to give you the money to pay the doctors. That's the indemnity program. All right, so service plan versus reimbursement or indemnity program. Those are the two types. And some companies give you choice. Now, this is called an assignment, where you can actually choose where you want your claim payment made, either directly to the doctors and hospitals or to you to pay the doctors and hospitals yourself. And that's called an assignment. Now, keep that separate from life insurance. In life insurance, an assignment is transferring the ownership of the policy from one party to another. But in health insurance, an assignment is assigning your claim payment. All right? Renewable. All right, there's different types of renewable contracts. All right? Cancelable. Well, this means the insurance company may cancel you during the policy period. We don't wait to the end of the policy period. We can cancel you during the policy period. Optionally renewable means the insurance company reserves the option to renew you at the renewal period, right? And or not renew you. And they may not even give you a reason if they don't renew you. Right? Out of the renewable contracts, optional renewable is going to be cheaper because the insurance company can choose not to renew you for no reason at all. Right? Since the insurance company has more control, it's typically going to be cheaper. Right? Out of all of these five, I have this list listed from cheapest, which is cancelable, to most expensive, which is non-cancelable. Right? And kind of in between. Right? So cancelable would be cheaper than optionally renewable, but usually they don't use that as that test question, which is the following has the cheapest premium. Optionally renewable is one you want. I haven't seen cancelable as one of the answers. Okay. Conditionally renewable. Well, this means if you meet certain conditions, we'll renew you. But if you cannot meet those conditions at renewal, then we don't have to renew you. Right? So this is, they cannot renew you because of health issues that progressed. This is a little tricky, but it'll be conditionally stated in the contract that this is what you're going to have to do at renewal. I had a client, he had a weight-related diabetes. If he's overweight, his diabetes kicked in, but if he dropped his weight below a certain level, his diabetes kind of miraculously went away. So it's a condition imposed in his contract that on renewal, he had to be below that weight specification, right? And it doesn't matter if he's overweight during the whole period. It's a 5-year renewable contract is what it was. It doesn't matter if he's overweight 4 years, he does a crash diet in the past year. But on the renewal date, we put him on a scale, and if he's below the weight, we renew him with no other questions asked, okay? So they have to meet conditions. Now, if he's overweight on renewal, they can choose not to renew him. And so it's good for my client to, maintain reasonable body weight to keep the diabetes away. It's also good for the insurance company because it reduces their risk in case he comes in overweight at renewal. Guaranteed renewable versus non-cancelable. In both of these, they're basically the same. All you got to do is pay the premium and you have the coverage. Right? Now, with guaranteed renewable, it's going to be cheaper initially. But on every renewal, let's say it's a 5-year renewable contract, every renewal, you're now 5 years older. So your rates will go up on every renewal. And unfortunately, you could price yourself out of the market. Non-cancelable is more expensive initially, but your premiums never change. So you'd almost want to compare this to a 5-year renewable term is equivalent to a guaranteed renewable contract, right? You're guaranteed to renew every 5 years as long as you pay the increase in premium. And then whole life would be like non-cancelable. Whole life is more expensive initially, but your premiums never change, right? And so you have that level premium the rest of your life. Right? A couple other items here. Most people purchase guaranteed renewable over non-cancelable. Number one, it's got the word guarantee in it. Number two, it's cheaper initially. Right? So that's one question. They usually use that with long-term care. Purchasers of long-term care typically purchase which of the following? Guaranteed renewable. Okay. Another question would be, with all things being equal, what should you, the agent, recommend? You should recommend non-cancelable. Again, it's more expensive initially, but you have a level premium from then on out. All right. With that, thank you very much. If you do have any questions, don't hesitate to reach out. Lauren at lgdconsulting.com. Okay. Thank you for your time. Good luck.